A man with conviction will overwhelm 100 with only opinions, and bears have no conviction in this market. The biggest sell-off yesterday in over 3 months saw absolutely no follow-through as dip buyers bought the dip and the bears who shorted the lows were fuel for the fire. But what comes next? The famous Santa Claus rally starts tomorrow, and it is the most bullish 7-day period in the entire year. But is the trade overcrowded? Today, we talk about what happens if we don't get a Santa Claus rally and we get the Grinch instead. Will the market rally, or will the famous Santa rally turn out to be a nothing burger? So join us today as we discuss stocks and the financial markets and answer the question, will Santa come to town? Hello ladies and gentlemen, welcome to the Daily Recap Show. My name is Chase. We do these videos every single day. So if you want more of this content, please subscribe, like this video. It really helps me out. Let's get into it. And we parred a lot of yesterday's losses today. Tesla outperformed. Apple sat this one out. Underperformers today were utilities and energy. It was a very risk-on session looking at tech, semiconductors, comm services. They were really the outperformers. And something I want to show you that the US wasn't the best performing sector. It was actually the international segment, everything from developed markets, emerging markets, the Eurozone, global as a whole, global miners. They were the best performers, and we're going to talk about why a little later. Now, looking at the best performing sectors, semiconductors, metals, GDX. No surprise there. These have been the best performing sectors in the last 5 to 7 trading days. And now metals has been pricing in a recession for the better part of the whole year. And I do think the market is re-rating it. And that's why we're seeing really strong performance in comparison to everything else. But if you actually have a look at overall the top performers, we're looking at technology, software, discretionary, financials, risk on sectors. That was the theme today. Today was just risk on. A lot of people just buying this dip, taking advantage of the Santa Claus rally that starts tomorrow. Now, the Santa Claus rally, the last 5 days of December, the first 2 days of the new year, 7 total trading days, normally returns about 1.32%, 79% hit rate. This is data since 1950. Since 1928, 1.66% return, 79% hit rate. It might actually be one of the most positive trading periods in the year, and it's a very crowded trade right now. It might be the most crowded trade of 2023, 2024. Even fund managers are now almost 100% invested, 97% on the NAM index, coming off the November low, very close to 22%. So fund managers have been chasing, and this is where we are right now. A lot of people are in equities, retail, institutions, family offices, everybody's in the S&P 500. We do know that this week has seen record inflows for the ETF SPY and a bunch of other ETFs as well. And bullish sentiment is in full force. And the new sentiment survey, nearly 53% of individuals are bullish, and this is the new 52-week 1-year bullish high. The bears did tick up a tad, but I think a lot of people who were sitting on the sidelines chose a side. They chose to be bullish. Some of them chose to be bearish. And we have to remember the quote, be fearful when others are greedy, be greedy when others are fearful. That's Warren Buffett. We are 1 day away from the start of the Santa rally. It starts tomorrow, but we are actually in the 2nd day of the Grinch barometer, and not many people know about this, right? 3 days before Christmas and the 3 days after Christmas, the total return. And normally if we get a negative Grinch, we often see positive January and a positive year. 16 out of 19 times we get a 4.3% on average return for January. 18 out of 19 times we get a positive calendar year. Very interesting stats. And this is how we're doing so far. Negative 1.47% yesterday, up a percentage point today. So far, the Grinch barometer is negative. And if we can get a negative Grinch, a positive Santa Claus rally, that is going to be a huge risk on signal for 2024. Because when we get a positive Santa Claus rally, we normally have a positive calendar year as a whole. You could see a Santa Claus rally, 1%, 0.3%, 1.3%. We normally have returns of like 23% for the calendar year, 14%, 28.9%. Now it's not set in stone. In 2017 to 2018, we had a positive Santa Claus rally and we did get a negative year, but this is just the average. And if you do accumulate all of it, the Santa rally does coincide with a positive calendar year more times than it doesn't. Yesterday's sell-off was actually well within seasonality. We normally do see a bit of a dip anywhere on the 13th, 14th, or 15th trading day before we do get the December run. That's exactly what we saw. So for those of you that bought this dip right here, congratulations. And here's some data I have on massive 1-day sell-offs when we've made 52-week highs. So the S&P 500 after a 52-week high followed by a loss of greater than 1.45%, and even just 1 week later you can see a return of 0.1%. But looking at 6 months and 12 months on, you can see returns anywhere from 4 to 7% in the S&P 500. So very, very positive and quite the hit rate right there, 76%. Now, if you bought the dip yesterday, the stats are on your side, and let's talk about data. So we got economic data today, initial jobless claims. This labor market continues to be tight, and that's really great. I'm so glad that Americans have jobs and they're getting paid for the jobs that they have. Now, we did get core PCE right here. The actual was 2% for the third quarter. Now, we do get the year over year and month over month PCE data tomorrow. So go ahead, hit the subscribe button. I'm going to cover that tomorrow and keep you guys updated. But to see core PCE for the quarter come in at 2%, very interesting. It's going to be really, really interesting. If we get PCE data anywhere in the 2% range tomorrow, the market is going to absolutely love that. Guys, there are risks to this. We are missing the consensus mark quite significantly on all of these. One thing I also want to show you guys, real consumer spending for Q3 fell drastically, 3.1% against the consensus of 3.6%. I think that's a 10% decline or 15% decline based on the consensus, as well as corporate profits, missing the mark by a substantial margin compared to the consensus. And this is deflation. This is literally deflation right here, guys. And I think this is why we're seeing stuff like the treasury term premium still in negative territory. I think the market as a whole are worried about deflation, recession risk. They do like the yields, and they're looking at this as well as the global economy, and they're looking at all of these things, these factors, deflation in the data, and they're saying, I want a hedge, and they're using treasuries as that hedge. And that's why we're seeing negative term premiums in the 10-year compared to the shorter dated ones. Now, the economy has remained strong regardless. We can see here that based on the data we saw, and non-farms still at an all-time high, personal income still really, really high. And this is why the US hasn't had a recession yet, because the consumer remains strong, and the consumer has actually been less sensitive to rate hikes than previously thought. Now, that could change at any moment, and we are sort of starting to see that change happen. We are seeing credit card delinquencies tick up, as well as household liquid assets go down. This is still above historical averages, especially for liquid assets against liabilities. And until these two converge, I think the recession is probably not going to come. But, this is trending downwards and this is trending upwards. And a lot of the policies from rate hikes and tightening only get felt 18 to 24 months after those policies come into place. So while this graph does show that the consumer is weakening into 2024, it's not something that we need to take immediately and run with it and start hedging our portfolios, because that's exactly what every pundit said in 2023, and almost everybody underperformed the market in 2023. What we really need to do in these type of situations is look at the data holistically and react, not predict, to what's coming our way, as well as combine it with other data from the macro, the fundamental, and the technical picture. And that's how we look at the data evenly. And then we say, even though they are converging, as it stands right now, the consumer is still healthy, and we position our portfolios accordingly, but it's something to look out for, something to watch, and if it changes, we then react. And one way we can combine the data with the fundamental picture is by looking at earnings of something such as Nike. Nike released earnings today and it was not good. They beat on EPS, let's be real, and they beat on margins as a whole ever so slightly. They missed on revenue, especially China revenue, and the main thing was the guidance. They saw a weaker revenue outlook for the second half, and we saw this headline, they're doing $2 billion in cost cutting. They warned of soft revenue. They're letting go of some employees. It's really sad. And this was the reaction after hours, and it was an absolutely brutal day for Nike, down 10% after hours, and it probably even goes lower tomorrow. So we are going to keep an eye on Nike over the next couple of weeks. Nike officially wraps up earnings season. We get earnings again in February around then, and it's been a pretty good earnings season, guys. But all in all, how have we done? 4.1% increase in earnings for the S&P 500 year over year in Q3, and we're officially out of the earnings recession. No more earnings recession. We can also see that the S&P 500 beat on revenue by 2.3%, and margins, it doesn't show right here, but the S&P 500 hit 11.1% in margins. Really good. And look at this, real estate, infotech, financials really coming through with top tier margins. Now, we've had a pretty good earnings season, but let's have a look at global growth. This is all countries excluding the US, right? And global growth is expected at 10.1% in 2024. And then in 2025, 11.7%. And I did show you guys yesterday that GDP globally was actually on the up and up, and now earnings is showing that too. And we can see that if we are to use the historical trend of earnings consensus downgrades and say that those numbers are going to be revised by 7%, we are still looking at 2024 earnings of about 10%, 2025 earnings of about 11.1%. So very, very interesting. And the reason why we're seeing this growth is quite simple. We're getting 5% on a cash yield. We're getting 3% on buybacks for your stock, and you're getting 2% in GDP, right? That's like an automatic 10% growth. Now, the global outlook does remain resilient, but let's talk about today's trade. For those of you that bought the dip yesterday, congrats. It's probably the only dip we're going to get for the rest of the year. We did par a lot of the losses we had yesterday. It was just a 0 DTE sell-off, nothing major. Looking at gamma, so this was yesterday at the open and today at the open. Have a look at the amount of negative gamma building right here compared to yesterday. So there are risks building in the market, and have a look at the amount of positive gamma here versus here, guys. So we still are at the 4800 as the core gamma resistance. I do still favor further price action to this level. However, do be aware there is a lot of negative gamma building. Now, it's not going to unwind immediately. It's going to take a number of weeks, and we are going to look for, some sell side, some weakness into the middle end of January, possibly February, around then. And if we also have a look at leverage for puts and calls, we can see that call leverage is decreasing right there and put leverage is actually increasing. And I do think these are a lot of sold puts, but overall leverage is increasing in general, but less calls, more puts, whereas like the call leverage has been significantly elevated over the last couple of weeks. Like I said, it's going to take a couple of weeks to unwind. It might not unwind. This is just data I'm looking at. I'm trying to give you guys an unbiased view of both the bull case, the bear case, and then we can make informed trading decisions from there. So don't expect a sell-off. I do think we actually go higher. I'm going to tell you exactly where I think we're going to do for the rest of the week for 2024 into early January. Having a look at what we did today, looking at the gamma heat map, we gapped up on the open, moved lower, found a dip right here in this neutral gamma zone, and then we slowly made our way up. When we entered this positive gamma area, we did see a bit of a sell, but dealers don't just sell in positive gamma zones, they sell rips by dips. Dip was bought at the bottom of this level, and we actually broke through this positive gamma area. And the second we did, we entered this negative gamma zone, and that's why we ripped higher and continued to move higher towards the 750 area. So guys, just something to be aware of tomorrow. There's a huge negative gamma zone right here. If we gap up into this level, right, market makers might gap us in. Dealers are going to hedge with the trade, which is to buy, and we're probably going to run up all the way to this 4770 level. But if we gap down into this 4740 area, we probably go towards 4730, where we should see buy side support in this positive gamma zone. So it really depends what's happened with the gap. We gap up, we go higher. We gap down, we actually go lower, because we're right in the middle of two negative gamma zones. However, this isn't really a big negative gamma zone, but there is massive amounts of negative gamma building in the tape. Looking at the S&P 500 chart, guys, and I do think we're going to go ahead and hit 4,800, possibly 4,850, the absolute maximum top of the range. Yesterday's sell-off was really good. You'll see a lot of these charts, they're not as oversold as they were just a couple of days ago, and I still favor higher price action for the S&P 500. Again, my target is 4,800, maximum target 4,850. Looking at the volatility index, something you need to be aware of, guys, is that as stocks are moving up, volatility is also moving up. We did see a massive spike intraday, and then short vol strategies took us back down. But just be aware, I did mention on Twitter that if we see stocks up, VIX up, it's going to lead to a blow off top, because eventually we're going to get the short vol trade, VIX down, stocks absolutely ramp up. And that is going to be when we want to start looking for our shorts if we do get that. Looking at the TLT, very similar situation. It's sort of just basing around here, and that's all I want to see with TLT. Stay above the 200 moving average, kind of just consolidate, and let's look to the 109 area, possibly January and as early as early February. And something to note, looking at dark pool trades, we've seen some very big trades come in on the TLT, and we didn't move much lower, and the biggest trade ever come in right at today's lows. This is a key level right here, this 99 level, guys, to look at. I think if we get above this level and continue high, it's going to be really, really well, but it does seem that there is quite a bit of support at this 99 level, especially since the biggest trade coming in. Now, looking at Tesla, a lot of traders are looking at a breakout towards the 300 area in Tesla. We were up like 2% today. I'm not too sure if we're going to get that. I mean, have a look at these dark pool trades. Very, very interesting. And I could be wrong, but huge trades coming in here, 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 kind of at the top of the range, why would institutional investors be making trades at the top of the range? I mean, wouldn't they want to buy at the bottom of this range? I think what Tesla's going to do for the rest of the year is just underperform the rest of the Mag 7 and just kind of do this. Looking at the equal weight, interesting stuff. So above this 55 level, we've been looking at that for a while and does look like it's offering very, very good support. We just kind of want to keep building here and then move higher into the new year. We have worked off a lot of these overbought levels and the RSI looking a lot more healthier for the equal weight. Looking at gold, something we haven't looked at yet. After this massive all-time high, we then sold off, and gold is sort of just consolidating in this area right here. It has had a fantastic run this year, particularly in the last 2 months. I do favor gold to get to that 2200 level in 2022, and this consolidation is really good. Just kind of want to build a very strong base right here for gold to go ahead and hit the 2200 level. Looking at crude oil, it has bounced off the 67.54 level, but until either supply issues fix themselves with the US just cutting supply or demand really comes back in a substantial way, crude is probably going to retest this area right here, not go any higher than the 200 moving average. $80 oil with the demand we're seeing right now is probably something that crude can't do. Looking at Micron, gap up, looks healthy. This looks like a very healthy chart. This is just like higher highs, higher lows, and probably going to go higher. It's probably going to go high in 2024. Great outlook. One of the best performing years for Meta ever, and it just keeps going higher. One of my holdings in my portfolio, and I do think we'll probably go see 400 level in 2024. Don't fight the trend. This is mid-caps S&P 400, the weekly chart. We've broken above this key level. We sort of just want to use this as support and go ahead and try and hit new all-time highs, potentially this 3000 area. Very bullish on mid-caps in 2024. Now looking at IWM, this is what we want to see. This is the line that has seen massive amounts of sellers as well as huge dark pools come in. The market is deciding what it wants to do. Right now, it doesn't really know. There's a lot of indecision right here. Maybe it wants to go fix this gap, but bears really need to hold this line or bulls really need to push above. And I think we're going to see the answer to that over the next 7 days. Looking at Uber, this is a tech name I've been looking at for a while, but just never pulled the trigger. And they've absolutely bounced off the 200 DMA, and it's been quite the rally ever since. But their top line revenue isn't growing as much as you would like for a company that's at like 50x. So it could be slightly overvalued. Maybe we see a pullback to like at the 50 level. If we can get back in there at the 50 level, that's going to be pretty good support for Uber, and I might buy that in 2024. Now, looking at ASML, a stock I've been evaluating for fundamentally, looking at holding it for multiple years, and this is pretty much a monopoly. They're the only high-level chip lithography manufacturer in the world. So there is monopolistic value here and pricing power they have. The stock has struggled to break above this level, and this is where we are right now. Huge resistance right here, but I'm going to release a full analysis on ASML in the future because I do think it's undervalued on what it can produce over the next 5 to 10 years. Looking at American Express, very strong. This looks like a very strong chart, breaking above the 179 key level, 180, and it probably wants to go test new all-time highs at 200, 202, and not that overbought as well. Bullish on American Express. I do think it's one of the best banks and card issuers out there. I released my top undervalued stock picks for 2024. There's 11 picks. So go ahead, follow me on Twitter. Go check these out. It's just on my feed. And I do think these 11 picks are going to outperform the S&P 500 in 2024. Data tomorrow, PCE month over month, year over year. If we get anything 2% or less, the market is going to absolutely flip at that because it means rate cuts are definitely coming. Going to see yields fall, bond prices rally, stocks rally in a seasonally bullish period. But if PCE misses and doesn't come in the way we want, it's going to be a rough situation. We also got durable goods as well as new home sales. So a lot happening tomorrow. And if you've made it up until here, thank you so much for watching, guys. Please like this video, subscribe, hit the notification bell, leave a comment. Cheers.